It began with a disappearance. In 2008, as the world's financial system was collapsing under its own weight, an anonymous figure named Satoshi Nakamoto posted a 9-page document on an obscure mailing list. Its title was simple but radical: Bitcoin, a peer-to-peer electronic cash system. The timing couldn't have been more symbolic. As governments printed trillions to save banks, Nakamoto offered something different: money without intermediaries, trust without institutions, value without borders. To many, it seemed like a manifesto for a new financial age, one built not on faith in governments, but on code itself. But behind the promise of freedom lay a question that would haunt the decade to come. Could trust really be replaced by technology? The story begins with a crisis of faith. In 2008, Lehman Brothers collapsed, and with it, the illusion of a self-regulating financial world. Decades of deregulation had turned the global economy into a web of debt and speculation. The ordinary saver watched their bank accounts shrink while the institutions responsible were rescued. Trust, the foundation of all money, cracked. Out of that vacuum, Bitcoin appeared not as a currency, but as an idea, a protest against the centralized order that had failed. It was designed to be everything traditional money wasn't: transparent, limited in supply, immune to manipulation. Instead of central banks, it relied on a distributed network of computers verifying transactions through cryptographic proof. In Nakamoto's words, "We have proposed a system for electronic transactions without relying on trust." At first, few noticed. Bitcoin was traded by hobbyists and cypherpunks who saw it as digital gold, a hedge against corruption and inflation. Early adopters mined coins on laptops, sharing them freely. In 2010, the first real-world purchase was made: 2 pizzas for 10,000 bitcoins. The idea was alive, but its value, both literal and symbolic, was still uncertain. Then came the rise. By the mid-2010s, Bitcoin's decentralized vision collided with a world still scarred by financial crisis. Central banks were keeping interest rates near zero. Savers saw no return. In that vacuum, speculation rushed in. As Bitcoin's price surged from cents to hundreds, then thousands, it drew not only idealists but investors, technologists, and opportunists. Exchanges like Mt. Gox emerged to handle the flood of trading, and with them, the vulnerabilities of a system still under construction. Hacks, thefts, and scandals followed, but so did profits. The myth grew that a single idea could rewrite the architecture of money itself. By 2017, Bitcoin had become a global phenomenon. Taxi drivers discussed it, news anchors debated it, and governments began to fear it. New coins, altcoins, flooded the market, each promising innovation or revolution. Ethereum introduced smart contracts, programmable money that could automate agreements. The term blockchain became a buzzword adopted by banks, corporations, and governments. Initial coin offerings, or ICOs, allowed startups to raise billions in cryptocurrency from investors around the world, often without regulation or accountability. It was the internet boom of the late 1990s, but on fast forward. Yet history rarely offers new miracles, only new disguises. As money poured in, greed replaced ideology. Tokens were created out of nothing, marketed as the future of everything, from art to real estate to social networks. Some delivered breakthroughs, most sold illusions. Behind the screens, scams flourished. In 2017 alone, over $4 billion was lost to fraudulent ICOs. Still, the prices climbed, and so did belief. When Bitcoin neared $20,000, the narrative seemed unstoppable. Banks were obsolete, governments powerless, and the new world was coded in cryptography. But gravity never disappears. In early 2018, the bubble burst. As investors rushed to cash out, billions evaporated. Bitcoin lost more than 80% of its value. Thousands of coins disappeared into digital oblivion. Regulators, once hesitant, began to intervene. The Securities and Exchange Commission cracked down on unregistered offerings. China banned exchanges outright. For a moment, the dream seemed over. Another speculative mania joining the history books, alongside tulips, railways, and dot-coms. And yet, the story didn't end there. What survived was the infrastructure, the networks, developers, and believers who refused to abandon the experiment. In the years that followed, the crypto industry professionalized. Major exchanges introduced regulation and custody solutions. Wall Street, once dismissive, began to invest. Bitcoin ETFs, institutional funds, and corporate treasuries entered the scene. In 2020, when the pandemic struck and central banks once again flooded the world with money, Bitcoin's message regained its force. Inflation fears reignited faith in digital scarcity. By 2021, Bitcoin hit $69,000. For a brief moment, it seemed unstoppable again. But beneath the surface, the same old forces were returning: leverage, speculation, and human psychology. The crypto boom that followed was not about decentralization, but profit. New tokens like Dogecoin and Shiba Inu became viral sensations, propelled by memes and social media rather than innovation. Then came the rise of decentralized finance, DeFi, where algorithms replaced banks, offering high returns and little oversight. At the same time, non-fungible tokens, NFTs, turned digital art into tradable assets worth millions. For a moment, it felt like a new digital renaissance. Everyone was rich, on paper. Then came the crash of 2022. The collapse of Terra USD, a so-called stablecoin, set off a chain reaction. Trillions in crypto wealth disappeared. Hedge funds imploded, exchanges froze withdrawals, and icons like FTX, once the face of legitimacy, were revealed as mirages of accounting tricks and misplaced trust. Ironically, the movement that began to eliminate intermediaries had recreated them, only faster, riskier, and less accountable. The illusion had come full circle. By the time the dust settled, the parallels with history were unmistakable. Like the dot-com bubble, crypto had been built on genuine innovation inflated by fantasy. Like the gold rush, it created fortunes but left behind empty minds. And like every financial mania before it, it revealed one truth that technology could never change. Trust cannot be programmed, only earned. Yet the aftermath, like in Japan's lost decade or the 2008 crash, didn't erase the idea, it refined it. Out of the wreckage came sober reflection. Central banks began exploring their own digital currencies. Governments adopted blockchain for record-keeping. The underlying technology, stripped of hype, found real uses: supply chains, identity systems, cross-border payments. Bitcoin itself endured, not as a revolution, but as a reminder that the desire for financial freedom remains as strong as the temptation to believe in shortcuts. Today, the crypto world stands divided between those who see it as the foundation of a new financial order and those who see it as digital alchemy. But both sides share a common inheritance: a decade that proved how easily innovation becomes speculation when money is involved. The dream of decentralized trust is still alive, but scarred, no longer a utopia, but a test of endurance. Three lessons remain. First, technology can amplify trust, but it cannot replace it. Every system still depends on the belief that others will play by the rules. Second, in the absence of regulation, transparency becomes a paradox. Too much data, too little understanding. And third, every revolution in money, from gold to paper to code, begins with idealism and ends with compromise. The crypto craze was not the end of money. It was a mirror reflecting our oldest economic instinct, the search for certainty in uncertain times. Whether that certainty comes from governments, markets, or algorithms, one truth endures. The foundation of all value is belief. And belief, once broken, must always be rebuilt. If this story made you see digital wealth differently, subscribe to Economic Collapse. Because every innovation, no matter how advanced, eventually faces the same test. What happens when the code that promised trust is the first thing people stop believing in?